So today we are going to again begin a new topic, that is fundamental analysis. And today we are going to touch a new financial statement, that is balance sheet. So this video will be in continuation to just the previous video, that is profit and loss statement. So I want you to watch that, and this will be a continuation for this. So I hope you had a good day, and let's begin the new topic. Now let's begin today's topic, balance sheet. It's not going to be a theoretical class. It's going to be a conceptual plus practical class, as we had already completed our profit and loss statement. It would be just in the continuation to that. Now let me show you a small glimpse, guys. So in the previous video we completed profit and loss statement. So today we are going to start balance sheet. So these are the, you can say, few headers in balance sheet. And today we are going to combine research of two websites. One would be Screener. It's free. I want you to have make a profile over here and start using it. It's completely free. Second one is moneycontrol.com. So we will be using this website as well. Why? Because we will be using two different types of criteria for the balance sheet. Just a moment. Kingfisher Airlines. So let's begin with today's class. So as balance sheet is just a snapshot. It's just when you and your friends are hanging out together and I just click a photograph. It's just a photograph, a snapshot of company's financial position at a specific time, at that time when I am shooting the photo. I hope you got the point. Means you and your friends are hanging out, I click the photo, so it is the moment, at that moment what you were doing. So balance sheet is the financial statement that provides snapshot, a picture of company's financial statement, company's financial position at specific point, at that specific point. So what is the purpose? So purpose is definitely to get to know what are the assets and the liabilities. So these are the two very important headers that we will be studying. What are the assets companies owning and what are the liabilities companies having? And within the liabilities, there are shareholders equity as well. Means we use liability to buy assets, and the liabilities could be debt as well as the equity. So we are going to discuss that thing as well. So what is the purpose? So purpose is to get to know what are the liabilities and what are the assets on the company, right? So importance is that it will help us to decide and to make the decisions for our own investments, basically, right? Now let's have a small basic overview of a balance sheet, guys. So in accounting, basically, the company, the owner of the company, and the management of the company, they all are considered as different entities. Let me repeat myself again. Since I am starting a business, I am owning a business, I am an owner of a business. So it doesn't mean me and the business, we are one unit. No. According to accounting terms, me and the business, we are different terms. So whatever money I am putting in my business, means my money I am putting in my business, that money will also be accounted under liability. So because business is a different unit, so whatever money, being a CEO or being a owner of the company, I put in a company, the company has to return it back. Similarly, whatever loan I take from a bank in this company, so being a company, I have to give that loan back. So management of the company, ownership, and the companies, they're three different entities. So it is considered for the easy management of the accounting, right? So what is a balance sheet? Let me, conclude the thing. It is a snapshot of company's financial statements at a specific time. So what are assets within this liability, within this balance sheet? So assets are something which company is owning. For example, let's take you as a human being, as an individual. So you must be having, the resources, like you must be having some gold, you must be having some stock market investment, some cash in the bank. Those things are your assets. You must be having some liabilities. Liabilities means you must be having some EMIs which are going on. You must be having some loans. You must be having some, few things which you have, which you don't own, but you owe to someone else. Those things are called as liabilities for the company, which company has to return back, right? Now, equity. Owner share after subtracting liabilities from the assets. That we are going to just discuss. This is very important to understand. And for equity research, All these headings will be very important to understand. Let me show practically over here, guys. So this is practical equity. So these are the liabilities, borrowings and the liabilities. Borrowings are also part of liabilities because I have to return the borrowing backs. Because if I have taken some loan, I have to return it back. All right. And then comes the assets, and then comes the total assets. So these are three very important headings which we have to see. Generally, I would like to add one more thing over here, guys. Balance sheet can be this small. Balance sheet can be, just a minute. Balance sheet can be smaller than this as well, and balance sheet can be 2 page long as well. But there is a difference. See, this is also balance sheet, a small balance sheet, easy to understand. The thing is that, guys, today we are not doing auditing. We are not learning auditing. What we are doing right now, we are researching. We are doing equity research. And in equity research, we don't have to dig so at so micro level. In auditing, we have to dig deep inside the financial statements. Even one rupee, one penny, where it is going, where it is coming, we have to, see that. But in research, we just have to see, we have to infer some points after the data. We don't have to dig so micro level. So it will save our time, and it's not audit, it is research. All right, so that is why simpler is better. Okay, so equity, which it's done. So this is a small, example of a balance sheet. This is how balance sheet would be, current assets, non-current assets, current liabilities, non-current liabilities, and shareholdings in equity. So this is how a normal balance sheet would be. You would be looking like a balance, you would be seeing a balance sheet. So they are main headings. These are the headings, and subheadings are also there. Now let's see. Let's make the things more easy, guys. So what do you mean by assets? So assets are the resources owned by the company. I hope this is also clear. So assets are of two types, current assets and non-current assets. In very simple terms, current assets are those assets, guys, which have the time which we use over here is 1 year, for example. So assets which are more than for 1 year and assets which are there for less than 1 year. So let's start from non-current. These are the assets which can be expected to be converted into cash within 1 year. So these are called as current assets. Means the lifespan of these assets are within 1 year. I hope this is clear, right? It could be cash or cash equivalent. So these are quite liquid assets, quite liquid, which are just equivalent or cash equivalents, right? Non-current assets, which are difficult to sell, which are very difficult to convert into cash. For example, if I have a real estate and I mean to sell, I want to sell my house or my home, so it will take a lot of time. Means I need to find a buyer, and then negotiations will go on. The cash transfer is so huge that it will take some time. So that those things are called as non-current, not immediate, right? So it's plant, property, equipments. All right, these things are which which are not expected to be converted into cash within a year. More the non-current assets, better the company is. Means the company would not immediately get vanish. What I wanted to say, guys, both the assets are very important for a company. Non-current assets means more than non-current assets, lesser are the chance of company to get, liquidated or go if they go bankrupt, or the condition of the profits are not good, the revenues are not good, even then the company can sustain for long period of time. But if the non-current assets are very, very less, then the current assets would be exhausted. And once they are exhausted, it will be very difficult for a company to sustain for a long period of time. I hope this is clear to everybody. Now, what are liabilities? These are the obligations that a company needs to pay. It is something which I owe to someone else. For example, if I have taken a loan or a small credit from my best friend, but I have to return it back to him, right? So these things are called as liabilities. So non-current liabilities are those which are for long duration of time, especially more than 1 year. So obligation which are not due within 1 year. So it is long run. You don't have to, it's no one is coming to hold your collar that why you are not giving the money immediately. So it is not immediate returns, right? For example, long-term loans, deferred tax means sometimes with government, I instead of giving the entire tax this year, I can give some tax this year and some proportionally some remaining tax I can give next year as well. So these are called as deferred tax. Pension obligations means if a person or if my employer retires, I have to give him salary or pension till the end of his life. So these are long-term liabilities which I have to pay. Current liabilities are the immediate liabilities, which I have to pay within 1 year, right? So these are short-term loans, which I have to pay, or these are the interest which I have to pay immediately to the banks. I hope this is clear to everybody. Now, this one is important, guys. The formula of balance sheet, why it is called as balance sheet? Because left-hand side is equal to right-hand side. Left hand side should be equal to right hand side, so that is why it is balanced both ways. Let me show you over here, guys. So see the total liabilities over here, 2811. See over here, total assets are 2811. So it means left hand side should be equal to right hand side. So it is given in this format over here. So over here you can see total liabilities 1051, total assets 1051. So both the numbers, both the end headers should be equal to each other. That is why it is balanced. So if I keep both the things in left side and right side, so left hand side should be equal to right hand side. This is how the process should be. The formula for this is assets is equal to liabilities plus shareholder equity. See, the thing is that, guys, we need to understand this concept. Generally, it is assets equal to liabilities. But this shareholders' equity is also considered under liability only. The main reason behind it because the business and the owner both are considered as different entities. So let me give you an example over here. Let's see. This is a bank. So this Zuno icon is a bank, for example. So the company took loan from Zuno. So it is a liability. Company has to return the loan back to Zuno. This is very important, right? Because this is a liability. So company owes Zuno now. Similarly, being a CEO or being an owner of the company, if I put my own money in a company, so as according to this rule, all the entities are separate entities. So company will consider me not as a CEO, just as a separate entity. So whatever money I put in the company, I have to return it back. So this is for one owner, I'm saying. Just imagine multiple owners are there. For example, shareholders. So whatever money they are giving to me, I have to return that money back someday. So that is why it is called as shareholders equity. And it is also considered under the liability section. And the loan obviously are also considered under liability section. Generally, how it works, guys, when a business starts, you know, so businesses don't have the money. Businesses need money. For example, let's start from this story only. So it's a new company. So new company needs money, right? Initially, we need money to execute the business. So some money I will be putting in the company. Some money I will be taking as a loan from Zuno, for example. So these are the loans which I took. One in the form of equity, another in the form of debt. Eventually, as the time will pass, so company will buy assets from either it is loan from the Zuno or my own money from the owner. Company will buy assets, and from those assets, I will start doing production or give services, and I will start earning money. So businesses starts from liabilities, and from these liabilities, businesses buy assets, and from those assets, businesses earn revenue, and then they start giving the money back to the loan, the creditors which have given me the money. So I will give loan back to Zuno and I will give CEO's money back to CEO. So this is how liabilities starts decreasing with the passage of time. Initially, when the company starts, liabilities are high. As the time will proceed, liabilities will start going down and assets will start going up and revenues will start increasing, right? So this is how a business works basically. So the thing is that over here, guys, so that is why it is important that shareholder equity is the initial money from which I buy assets. Liabilities, again, from liabilities I buy assets. I hope this is clear to everybody. Now, how it works basically. Everything held by the company but belongs to others is a liability. This is a very simple definition. And everything that belongs to the company is fixed assets. So it involves equity plus debt, both. Equity means shareholders or owners' money plus debt, the loan which company has taken. So using this money, companies will buy assets. Once the assets will increase, Production starts, sales increase, revenue increases, income increases, company starts paying off the debt back. So debt keeps decreasing. So everything, but the thing is that, guys, if the debt is increasing slow and steadily, is decreasing slow and steadily, it's a good sign. But even after so many years, debt keeps on piling up. It is not a good sign. That we are going to discuss, right? Now, I hope this is clear to everybody. Now, what is equity and what is debt? Very important. Which one is better according to you? Means if I start a business, right? So what would be better for me? Debt or equity? Or if I ask you one more thing, sir, is taking loan a good sign or bad sign for a business? So if business is taking loan, is it good or bad? So guys, I am building a base for you right now. The same thing will be applicable on whatever practicals we are going to do. All right. Equity is the money that doesn't belong to the company. It is owner's money, right? It doesn't belongs to the company. It means it is not expected to be returned back to the owners as long as company lives. Guys, this is very important line. For equity, I need not to return the money back, and I just need to give the profit generated to the owners. Only in the case when the money, when this money I have to return when the company goes bankrupt or company is shutting down or the businesses, my business have just collapsed, for example. So the entire company will get auctioned by the government agencies. And after auction or after selling all the assets, whatever, first government, all the fund, all the money which I have taken from the government, I will be government banks or PSUs or government itself. So I will be repaying that, then lenders' money. And at the end, I will give preference to shareholders. I hope this is fine. It means if the company goes bankrupt today, the shareholders who had given money in the equity to the company, their preference is in the last. First would be the government banks or the government, then the small creditors, lenders, and then comes the shareholder. On contrary, debt. This is a money belongs to lenders or banks. Company has to return it and with the specific time period. Means if I take a loan from bank, I have to return that loan, right? It's no way out that I can safeguard myself. And since it's the money which belongs to the bank, then guys, it's a liability. Both the things are liability generally. But the thing is that I need not to give equity back until and unless my company gets bankrupt. But that I have to give back. Let me concrete this concept on you with one more example, one more story. I'm a businessman. I want to start a business. I have a very good idea, but I don't have money. What I can do? I can go to my parents, take money from them. So what is the good thing in that? I need not to return that money back because these are my parents, right? I can go to my friends and I can take money from them or my relatives. But the thing is that they may not be that rich, or or they may deny to give me the money. Third thing I can go to a bank. If the idea is good, I can take loan from the bank. But guys, if I am taking a loan, so the interest rate would be again 10 to 14%, quite high, right? Then third thing I can do, fourth thing I can do, I can issue a bond. I can go to a public. I can go to public like a politician. I can ask public to give me one rupee each of whatever money they are having. Just like a politician going to people and asking for votes. Similarly, being a businessman, I can go to public and I can ask loan from public this time. On on return, I can give them a guarantee that I, Pranavas, with the stamp of my company and signatory of my being a signatory of my company, I will give a signature, a guarantee, a promise that give me 100 crore rupee from so many people, not just one person, so many people. You just give me money, collect the money, give it to me, and on return, I will be giving 10% or 7% returns, 7% interest on that. So for them, it's an investment. For me, I took loan, but not from the bank, from the public. The difference between bank loan and the loan from the public is that for to bank, I have to pay 10 to 14% interest. To public, I have to pay 7%. That would be fine. So these are called as bonds. Now there is one more way. This time I can go to public, asking the public to become my partner straight away, partner of my business, and give money. invest money in my business. And in return, I will share the profits. Very good thing. So over here, again, I raised 100 crore rupee from so many people, and I made all of them my partners. But the thing is that I don't need to repay the money back. So 100 crore rupee I can use the way I want. I don't need to pay it back. So that is my money, right? This is equity. In this, only one thing that will be hampered, that is my decision making. Now, to make a small decision, I have to do voting amongst all those people who gave me money. So if I want to, buy a new company, or I want to expand, or I want to start a new factory, I need to take permission from all those people. And the voting should be in the majority. If they don't vote, I will not take the decision. I cannot take the decision. So I hope this is clear. Equity is better as compared to debt. But in equity, only the ownership is diluted. So that thing we are going to discuss as well. So debt is also good. Debt is good until and unless there is no macro level negative impact. Secondly, until and unless your company is making good revenues or good income or good sales. Why? Everything was going fine till the corona hit. Companies were taking good high amount of loans, they were expanding, right? Immediately macro level event happened and all the many companies collapsed because now there were no sales, no revenues, no incomes. So debt is good only and only until and unless you are earning money. If you are not earning money, that is a bad thing. Same can happen in your personal life. But I wanted to say over here, if you are having salary, regular salary, you can take loan and you can return the loan. That's fine. Means you can repay regular EMIs. But just imagine, guys, you have EMIs, you have loans on your head, and you lose your job, you lose your salary. Then it will be a very difficult situation for you. Same happens with the companies. I hope this is clear to everybody. So why we learned this thing? Because practically now we have to see debt to equity ratio. So debt to equity ratio is very important criteria in balance sheet as well. So this is just a small comparison. A practical tip I would like to give you over here, guys. I want you to see. Now let's compare it over here as well, how it will be working. What are the few parameters that we have to see? Let's jump into practicals as well along with it. Now, this is equity capital, right? These are reserves, right? So we are starting with Kingfisher Airlines. It's a very negative company. I'm giving you an example which come such what balance sheets are not good balance sheets. So we are starting from not good towards good, right? These are the borrowings, the loans. These are the other liabilities, could be current liabilities as well, right? These are the fixed assets, right? So these are the, capital work under progress or in progress. You can see like this, in some building or something like that. These are the investments and these are the other assets, could be taken as current assets. I hope this is clear to everybody. Now, I want you to see very carefully over here, guys. Reserves are the profits that is getting accumulated. Let me repeat myself. Reserves and surpluses are the profits that gets accumulated with the passage of time. So with the passage of time, for example, 2006, 7, 8, 9, reserve should be increasing. This is the first criteria in a good balance sheet you will be seeing. That is, are the reserves increasing progressively every year? This is the first thing that you would be seeing. So these are called as reserves and surpluses. It should be increasing. So over here, let's see, is it increasing? It was, but then it became negative. So it went low and low and low. So it's a red flag, completely no, cross. Now, next thing that we have to see is let's open over here as well. So these were the reserves. So guys, over here it's left to right, huh? Don't get confused. It's from right to left, not left to right, huh? So 2009, 10, 11, 12, 13. So we have to see this towards this side. So reserves and surpluses are negative and eventually they are increasing. So it's not good. Means it is getting exhausted, so not good. So you can see the graph as well. Now, second thing, guys, one more thing that you have to see. The current liabilities, right? The liabilities are increasing. Okay, it is increasing, not a good sign. Chalo, liabilities do generally get increased, but these liabilities should always be less than current assets. Let's see over here. The current assets are decreasing. Not a good sign. Every year, the liability should be less than the current asset. This is our second criteria, guys, right? We have to relate current liabilities with the current assets. All right. So current liability was high. Over here, current asset was low. It was high over here, it was low. And throughout it happened the same way. So according to a good research, according to a good, if you are researching for a good company, the current assets should always be higher than the current liabilities. We have to compare current with current. All right. And every year, the liabilities should be in decreasing and this should be increasing, but never mind. But if I say the second criteria that I have to say, the current liability should always be less than the current assets. And reserves and surplus should always be increasing. I hope this is clear. So we discussed two criteria till now. Now, debt to equity. That was the third criteria, very important criteria. So other liabilities are debts, long-term borrowings, for example. So current was less than 1 year and other liabilities are more than 1 year. And this is equity, guys. First two columns are equity. It involves shareholdings. So these are the shareholdings investments. So as I told you, shareholders are different entity. Plus these are the reserves and surpluses. So these are profits which either need so so company earns profit every year as I told you. So in equity, when if someone had become my partner and that is equity, he had given me some money, so I have to share my profits with him. I hope you remember in equity, I have to share the profits. I need not to return the money back. So this is the accumulated profit over years. So combining these two together, first two columns means equity should always be higher than the debt. But is it so over here? No. Over here, debt is higher than this. So just see. This is 1,000 crores. This is 6,000 crores. It means this company is taking more and more loans. And for loans, you have to return it back. It will become very difficult for a company to survive in the long run. So this is the third criteria, means debt to equity ratio. This is equity. So equity should always be less than the debt. On contrary, it was different. Over here, it was in negative and it was very, very less. And loan was increasing throughout. So this is a very important criteria, debt to equity ratio. So in this balance sheet, this is for Kingfisher. All the things were bad. The reserves and surplus, they were decreasing. Very bad. The current liabilities were high, more than as current assets throughout. Again, it was a bad situation, right? Third thing, the loans, the debt liabilities, loan from the bank was, high as compared to this. I hope this is clear to everybody. So these are important criteria that we have to see, guys. I hope this is clear to everybody. Now, let's come back to this. So what I wanted to say, the current liabilities should be tackled with current assets, right? Reserves and surplus should be increasing. Apart from this, equity should be higher than the loans, right? That is called as debt to equity ratio. That should not be high. In some cases, it can be high, but guys, that we have to see. Now let's see an example of a good company, TCS. So a small disclaimer, guys, over here, whatever being taught in the class should be considered as educational advice and should not be considered as investment advice. It is just for the sake of your research and for the sake of education purpose, right? Okay. Now let's scroll down. Okay. So balance sheets. So again, from this side to this side, are reserves and surpluses increasing? They are increasing, right? So first thing is good. Second thing, these are the share capital. Okay, the share capital is all nearby constant. It's right, it's near to constant. Okay. Now let's see, are these first two columns greater than the loans? Let's see. Okay. Reserve surplus is 90,000 crores, loans just 9,000 crores. Reserve surplus and share capital both 93,000 crores. It is just 9,000 crores. It means loans are less. Progressively, it is quite less. So lesser than the first two columns. So debt is less as compared to equity. Good sign for a company. Right now, Let's compare to current with current. Now, are current liabilities less than current assets? Let's see. So over here, current asset is 112,000 crores. Over here, current liabilities are just half or less than half, 46,000 crores. And is it a trend throughout? Yes, it's a trend throughout. So it is a good sign for a company. So what I want to say, the first two, the second heading is very important. Current liabilities we have to compare with current liabilities. Then we have to see what is the debt on the company, right? And then we have to compare the debt with the equity. The first two columns are the equity of the company, right? I hope this is clear. One more thing you can see over here, guys. You have to compare other liabilities with other assets. So as I told you, means we have to compare with current, similarly other liabilities with other liabilities. Why we are comparing this way? Just imagine, guys, you have an electricity bill, for example, and to pay that electricity bill, you have to sell your house. How absurd that statement could be. To repay your electricity bill, if you have to sell your TV, sofa, or your gold at the home, that would be the most absurd thing. So to pay that electricity bill, it should be paid from your current assets. For example, the current salary which you are getting, not by selling your home. Similarly, the current liabilities should be tackled by should be financed by the current asset. So that is why we are relating this. It's not like that current liabilities should be paid by other fixed assets. Means for an example, if electricity bill comes and a company owner has to sell his factory, the worst and the most it could be the worst business and it could be the absurd statement. So that is why we have to relate with current to current means we have to pay or finance these current liabilities only with current assets. Similarly, we have to pay other liabilities from other assets. So other assets should be greater than other liabilities. Again, it's a good sign for a company. So till now, it is a good sign for a company and balance sheet is also quite optimum. Means it's not the best, but it's not the bad as well. I hope this is clear as well, clear to you. So this is how we have to do the research, guys. If you are not using money control, it is also free website. You can use the same concept over here. So in the screener, the reserves should be increasing. So this is for Kingfisher, it was decreasing, right? So let's open TCS over here itself. TCS. Now balance sheet. Now let's see. Reserves were increasing. Absolutely, they were increasing. It's a tick, it's a thumbs up, right? Now borrowings. So over here, guys, it's not clear over here, right? How which are current and which are long-term liabilities. But generally, we can say borrowings as long-term liabilities, non-current liability, I would say, or other liabilities as current. Over here, it's opposite. So I don't want you to get confused. So we will compare other liabilities with other assets. So other liabilities are less than the assets. Absolutely. So again, it's a second thing. Now let's see, is this equity? The first two columns are equity, means reserves and surplus, it is equity, and this one is equity, right? The money raised from IPO basically or FPO. So these two columns should be higher than the borrowings. Is it so? Absolutely. So debt is quite low. Over here, 90,000 is the profit, reserves and surplus. 7,000 was the loan. So this is how we will be seeing, we will be relating current with current liability with current asset, equity with debt, right? And other liability with other assets. So this is how you'll get to know what is the condition of the company going on. Along with that, you can see the cash as well if you want to. Cash equivalent means cash in hand, or you can say operating cash, capital. So working capital, formula of working capital is current asset minus current liability. You can find it in this way. That is why the current asset should be higher than the current liability. Or you can see cash equivalents as well. That's also fine. But this we are going to see this thing in the cash flow statement as well. But I hope till now this is clear to everybody. So this is how we will be using balance sheet, and it is very important to analyze a good balance sheet. So in Kingfisher, what was happening? Let's open the Kingfisher, the bad one again, the bad guy over here as well. How we will get to know which was not a good company to invest in. So that was, see, the reserves, they were decreasing throughout, a bad sign for a company. The loans were increasing throughout, a bad sign for a company. So loan was more than the equity, again a bad sign because I the com he was not raising money from the shareholders or his own money. He was not putting his own money. He was taking more and more loan, and loans were increasing a lot. So it was a bad sign. So uh, other liabilities were also increasing, though he managed to maintain the other assets. So let's see it over here, guys. The assets part. Here it is, balance sheet. So what was happening? Current liabilities were this, right? 5,000, 5,000, and then the current assets were very, very less for the better clarity. So throughout it was happening in the same way. So it was again a third red flag. So this is how we have to reject the companies, guys. I hope this is clear to everybody. Now let's take the few takeaways and then we'll come back to again to the balance sheet practical. In the beginning, guys, company use liabilities, that is equity plus debt, money from the shareholders plus a loan from the banks as well to buy assets. Once they buy assets, they start their functions, operations, could be services, production. Once the services or production they start earning money, and that money goes to profits, income in profit loss statement and reserves and surplus in balance sheet. Now, this reserve and surplus will be used to either repay back the loan, right? This reserve and surplus can be used for the expansion of the company. So that money can be used for the expansion, right? If not paying back the loan, the money can be used for expansion. Thirdly, the same reserve and surplus can be used to give the dividends to the shareholders for sharing the profit that I told you. So again, it's a question, a homework for you that which company is a good company, which gives more dividend or better capital gain. So it's a homework. So if I tell you generally, guys, the company which is giving good dividends may not be a good company to invest in. Invest in. Our main motive for investment should not be dividends. It should be expansion of the company. More company will expand, more profits. So I can earn more capital gain. So my being investor, my motive should be capital gain, not the dividends. So which company is a good company who distributes? So, for example, uh, this is again Kingfisher, TCS. So, if the company is using this money, reserves and surplus, the profits, the retained profits, in expansion, it's a good sign because company will grow more and more, and I will earn more and more capital gain. But if this company starts, if this reserve starts decreasing, it means company may have given some dividend or some bonus. So that is also good, but that will eventually affect my capital gain as well, guys. All right. So I believe the better company is that which uses this profit for its own expansions, not just to make people happy. So there are few companies whose share price doesn't grow if assets doesn't grow, but company just distribute the money, or company can use this money to buy more and more assets as well. That can also be done. That's also a good sign for a company. But that company is a completely bad company where reserves are used not to buy assets, not for the expansion, just to give dividends. So this kind of, which companies do does such kind of things? PSUs, government PSUs. They just make their investors happy. Not a good sign. Now, debt to equity ratio, initially it can be high, but as the time passes, I told you, reserves and surplus will increase and it should reduce. Debt should be reduced, should be less. Debt to equity ratio, it is the formula is share capital plus reserve and surplus plus reserve and surplus, divided by, oh, sorry, it should be opposite. Liability should be here and reserves and surplus and share capital should be at the denominator. Is a debt good for a company or bad for a company? Guys, when the company starts, as I told you, it takes debt. That's fine. Infrastructure companies also take debt. But the thing is that as the time will pass, it should reduce, right? The company should pay off the debt. So if the company is profitable, then debt is good. But if something wrong happens and company is at very high debt, it is a very risky company. Let me give you one more example over here, guys. Adani Enterprise. Adani Enterprise. So why I'm giving you example of Adani Enterprise? Because I wanted to say in infrastructure companies and in real estate companies, debt portion would also always be high because no infrastructure can be created without taking loan. Because to create highways, to create big buildings, seaport, or railway stations, you need to have a lot of money. If I give you example, Facebook was started sitting inside a room. To start a service sector company, you don't need that much money. But to start an infrastructure company or manufacturing company or real estate company, you need to buy machineries. These are called as capital intensive companies. You need to buy machineries, you need to buy land to start a factory. To run that factory, you need to have raw material. For those raw material, you need to have employees, workers working. So, in initial phase itself, they need money. So just see over here, guys. The reserve and surplus are increasing, that's fine. Share capital is almost constant, okay? But see the liability part, guys. Other liabilities, long-term liabilities, it is more and much higher than the other assets. It means this company is taking quite a good amount of loans. And this is also much higher than the other liabilities. Long-term loans are higher than the equity. I mean, debt is higher than equity. It Equity is around 35,000 crores. It is 80,000 crore loans. 64,000 crore is the loan. 31,000 crore is the equity. So this company is basically, I would say, is taking more and more loans. So that is why people are, so much. There is a human cry in market that Adani is inflating the prices. The price of the stock is very high, but the company is very debt intensive, guys. It is a very capital intensive job, and they are taking a lot of loans and easy loans from the government for the infrastructure as well. So for always remember this thing, guys. The companies like infrastructure companies, companies like manufacturing and real estate, the debt portion would always be high. And because of this debt portion is high, the returns would never be high. So if you ask me, sir, is it advisable to invest in real estate companies? No, it's not that much advisable, though it's your own choice. But just imagine if I take 10 years to build a flat, to construct a building, then sales will start. So it will take 3 or 4 years to sell all the flats. And once the flats are sold, right, only then I will get my money, revenue, being a builder. And you are my investor, so you will get your money after that. So see, the cycle is very long. So real estate cycle goes up to 5 to 7 years. So that is why the returns in real estate is very slow. You will get the returns, but the cycle is so long that it will take a lot of time, guys. I hope you got the point. So, few more takeaways. Company should have more cash in hand. That is good. That is current assets minus current liabilities. The current assets should be higher because this is the working capital. No, current liabilities should be financed by the current assets. That I already told you means current should be related to current. The small electricity bill and day-to-day expenses that should be taken from current assets only. For day-to-day expenses, you don't need to sell your house, you don't need to sell the factory, right? The current assets should be always higher than the current liabilities, guys. And the current assets, this is minus current liabilities is working capital. This is a formula. Other liabilities should be financed by other assets. So other, I will be relating with others only. Reserves and surplus should increase. If they are increasing, it can be used to either give dividend or for the expansion. I am in the favor of expansion. If the company is using the money for better expansions, that would be a good sign. Now let's see some another companies. Mm, let's see Dr. Lal Path Lab. Doctor, let's see Dr. Lal Path Lab over here as well. So guys, I want you to do this research at your home itself. We had already completed profit loss statement. So today we will be completing balance sheets and then we will be completing the cash flow part as well. So this is for Dr. Lal Path, guys. And let's scroll down towards the balance sheets. Okay, so here is the balance sheet. So let's see, our reserves and surplus increasing? Okay, they are increasing. Good sign. It's a thumbs up. What are the loans on the company? 192 crores. What was the equity? 17 crore plus 83 crores. So loans are much lesser, right? What was the loan over here? 307 crores, 1500. So you can see the trend. The trend is that debt is always less than the equity. So first two columns are greater than this, right? Now let's see the current part. Current liability and current asset. Current asset is 12, 11,000 crores. It is 400 crores, 900 crores. So it means current liabilities they had already managed to, it is less than the current assets. So they have good amount of working capital as well. Though numbers are not that high, but overall it's a good sign for a company, right? I hope this is clear to everybody. Now, the borrowings are less than this, current liabilities are this, like this, reserves are already increasing, so it's a thumbs up sign from my side. The next thing that we have to see, we saw are the financial statements good or bad? Then we have to see the ratios. And then we have to see when to enter, when not to enter. I hope this is clear, everybody. So if you are using screener, you can see the reserves were increasing, fine. Other liabilities are assets are throughout more, right? And the liabilities were less. Okay, it's also fine. Is equity greater than liabilities? Absolutely. Throughout, equity was greater than the liabilities. So that is also a good sign, basically. So yes, it's a thumbs up. Now let's see one more. Guys, there's just one problem in money control nowadays. Though I have the paid subscription of money control, still, the advertisement part is quite high in this money control. So it's a pro version I'm using. Still, there is a huge, you know, means the advertisement is quite high. Indigo, 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 Interglobe Aviations. Let's see over here as well. Interglobe. So reserves were increasing, but after that it became negative. So if such kind of negative things comes, guys, it's something bit fishy. Means I don't want you to invest wherever such kind of red flags are there, because the thing is that some companies the profit making is very difficult. So over here, reserves and surplus were in negative. So again, it's a flying company. So equity part, so equity was quite constant. So let's see the other liabilities. This is a big red flag, guys. The loans were much higher. See, 49,000 crore was the loan, and 1600 was around 1600 or plus 300 was 1900 was the equity. It's a big red flag. So it's a no. It's also a no. Two red flags, guys, right? Now, current liabilities and current assets. So current liabilities, though current liability is less than the current assets, so just one green flag. Rest everything seems to be very fishy over here. And why this is happening, guys? Because again, it is capital intensive. You have to buy aeroplanes, and to buy aeroplane, you need to spend a lot of money, guys. So over here, that is why they have to take a lot of loans. So if a company is having a lot of loan, and for example, if tomorrow I told you, if some macro level event comes, like COVID crisis, like world war, like fight between two countries, it will be very difficult for a company like this to survive, because loans become very difficult. That is why it is not advisable to invest much and so much in, especially in capital intensive businesses, because in this a huge amount of money from the loan is invested. So if the economy of world and economy of the country is good, and you have a prediction it will do good in future, and no macro level no you can say negative macro level event is going to take place, then it would be fine. Otherwise, it's not a good sign to invest in such kind of companies, right? Now let's go for one more example, guys. Reliance. How could we forget Reliance? Reliance Industries. Reliance Industries. Okay. So balance sheet. So guys, I want you to go through, list down the favorite companies, the companies you really like, the companies which you have a good inclination towards, and then I want you to do the research at your home itself. So let's see. Reserves and surpluses, are they increasing? They are increasing. Tick, green flag, first green flag. So these are the loans, other loans. So are these loans less than equity? So debt is less than equity. This is around 7 lakh crores, 5 lakh crores. So it's less, also less. So throughout it was, they managed to maintain it less. So both flags are green flags. It's a good sign for us. Now, current assets and current liabilities. Current assets are always more than the liabilities, current liabilities. Again, a good sign for us. So it's a thumbs up. So their balance sheet seems to be good, and it's a good sign for our investments. Now, it doesn't mean that I'm going to invest today only. I just found that this is a good balance sheet. The yesterday we have seen profit loss statements were also good. We have to combine all the research together. And when I'll see that all the things are good, good to go, absolutely, then you can wait for the right time to invest in such companies. So we have to find the companies where, few parameters, they should be quite good. If there is some negativity in these parameters, then it's a complete no to invest, guys. Means you should not be investing in such kind of companies. Now, one more company that we should be seeing, that is again from the medical side, Vijaya, or we can see HDFC AMC, HDFC AMC. Hmm. Over here as well, HDFC AMC. So balance sheet. So are reserves increasing? Absolutely, they are increasing very insanely they are increasing. See, is equity higher than the loans? So these are the loans. So if the loan was say 50 crores, equity is 5,000 crores plus this 100. Quite high, very high. 6,000 crore was the equity plus this 100 crores, so it is 400 crores. So second is also a green flag. Let's compare with other liability with other assets. So overall, if I say other assets are, so let's clarify this data from here. Let's compare the data over here, because over here the thing is that it's not clarified. So which asset is the current asset, which asset is a fixed asset. So for this we have to compare this thing with to this website as well. So that's why we have to use both the websites together. So we have the data of 2 years over here in this website, guys. So let's see. Uh, Current liabilities are this, and this is the current assets. Current liability are quite less, guys, and current assets are very high. So you can see the difference. So it's a thumbs up sign. See, the sorry, reserves and surplus were increasing, and equity was much low higher. See, it was around 6,000, and the loans were around 300 and 266. So loans were also very less. The debt was less. So debt to equity ratio is also in very optimum position. Current liabilities are very less than the current assets, guys. So it is again matching all the three criteria which we had already thought of. So I would say there are three parameters that we have to say, with combination of profit and loss statement, with combination of cash flow statement. But if something is wrong happening with these parameters, these are just 4 or 5 parameters, guys. If something is wrong happening or some red flags are there in these parameters, then it's completely no. You should not be investing in such kind of company. I hope this is clear to everybody now.